Assalamu alaikum. This is the fifth part on translation of foreign affiliate financial statements. And in this session, we will explain the basic concepts on translation of financial statement. We will explain the objectives of financial statement translation. We will explain how to identify the functional currency of a foreign entity. And finally, we will explain the difference between the two methods used to convert the financial statements of a foreign entity into Saudi Riyals. But in the beginning of this session, I would like to thank my son Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabiya Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. Please keep in mind that we are explaining these concepts with reference to a company in Saudi Arabia that operates not only within the boundaries of Saudi Arabia, rather it operates overseas too. It has its branches or subsidiaries in neighboring countries like Sudan, Djibouti, Oman, UAE, Kuwait, and in other parts of the world too, like Britain, Germany, Japan, or China. So, when the company reports its overall financial performance to its shareholders and prospective investors, it has to be reported in a uniform monetary unit. So, it has to translate the financial statements of its foreign branches and subsidiaries into Saudi Riyals. So, when a company is involved in foreign operations through its branches, subsidiary, or investee company, then the accounts of the foreign activities maintained in foreign currency must be translated into Saudi Riyals, as two different currencies cannot be added together. They have to be restated, that is, convert Japanese yen to Saudi Riyals, dirhams or dinars into Saudi Riyals before they can be added or consolidated in one financial statement. So the Saudi company has control over the subsidiary. Please note that controlling interest means that the company has more than 51% share in equity. Although there are some exceptions, like when the parent company don't intend to control or the control is temporary, then there is no consolidation. A foreign government can also restrict the control of the company, like it can restrict the withdrawal of assets or can even restrict exchange. The conversion from another currency into the currency of the parent company, a Saudi company in our case, the process is called the translation. So a Saudi firm having a subsidiary in Germany will translate its financial statements in Saudi Riyals. When translating in Riyals, it can be done either using current exchange rate or historical exchange rate or weighted average rate. We will be talking about the rules on the basis of which these rates can be used in the translation process. There are two methods of translation. One is called the measurement method and the other is called the translation method. We will talk about the two methods in a while after explaining an important concept called functional currency. A company will use remeasurement method or a translation method depending upon the functional currency. A functional currency depends on many economic factors, and these economic indicators help to determine the functional currency, like cash flow, how the company prepare cash flow statement, how the company make payment to suppliers, how does the company get receivables, what is the sales prices, what is the payment to employees, expenses, what is the cost of goods sold, financing, intercompany transactions. All these economic indicators help to determine the functional currency. A Saudi company will be reporting the transactions in Saudi Riyals. So the functional currency is Saudi Riyals. It will pay its employees in Saudi Riyals. They receive money from customers in Saudi Riyals. The banking transactions are in Saudi Riyals. So the functional currency may be the local currency of the foreign entity, or Saudi Riyals, or currency of a third country. We will talk about these three scenarios, taking into consideration that the company is from Saudi Arabia. The company head office is in Riyadh and has its branches in UAE, Oman, and Djibouti. The first scenario is that the subsidiary or a branch is in UAE. So all the transactions, payments, receipts will be recorded in dirhams, the currency of UAE. So the local currency, dirhams, is the functional currency. The first step is to determine the functional currency. In this case, it is obviously the local currency. And in such a scenario, the company will use the translation method. And if the company is using the translation method, the current rate method, also called the current rate method, and all the adjustments will be recorded in the balance sheet. So this is a normal scenario, because if the firm is operating in a foreign country, most of the time the functional currency will be the local currency. Second, in the second scenario, suppose the Saudi company has a branch in Ghuwaifat, a small town in far west of the Emirates of Abu Dhabi. This place forms a border crossing to Saudi Arabia. The subsidiary gets all its supplies from Saudi Arabia. They pay for the supplies in Saudi Riyals. All the employees are Saudi nationals, so they pay their employees in Saudi Riyals. The subsidiary accepts only Saudi Riyals for sales. So the Saudi subsidiary is operating in UAE, but the functional currency is Saudi Riyal and not UAE dirham. The rule to apply is to use remeasurement method, and when the company apply remeasurement method, then it must choose temporal method, and any adjustment goes to the income statement. In the third scenario, suppose the Saudi company has a subsidiary in Djibouti, and suppose this is a radical city and is French oriented, and the currency used in this city is French franc and not Djiboutian franc. So the currency used is of third country, France. So the functional currency is not the Saudi Riyal nor the local currency, the Djiboutian franc. Neither it is a rather it is a third country currency, that is the French franc. In such a scenario, the company has to do two things. First of all, measure the third country currency, that is the functional currency, using the temporal method. Second, translate the functional currency to Saudi Riyals using the current rate method. So let us recap basically what we have just said. First, the most common scenario is that the functional currency be the local currency of the foreign entity. As already explained, a Saudi subsidiary is in UAE, where all the cash flows are in UAE dirhams. Cost of goods sold are recorded in UAE dirhams. All the transactions are in the local currency of UAE, that is dirhams. Second, the subsidiary is operating at the border of the two countries where Saudi Riyal dominates, and the transactions that are mostly from the customers, suppliers, employees are Saudis, and the the functional currency is Saudi Riyal and not UAE dirham. The third scenario is that the subsidiary is operating in a country where the functional currency is a third country currency. Let us add one more scenario, that is the foreign entity operates in a highly inflationary economy, say a hyperinflation. Now, hyperinflation is a term to describe rapid, excessive, and out of control general price increases in an economy. While inflation is a measure of the pace of rising prices for goods and services, hyperinflation is rapidly rising inflation, typically measuring more than 50% per month. Hyperinflation can occur because of excessive money supply, severe economic turmoil and depression, or loss of confidence in the economy or monetary system. Hyperinflation occurred in the former Yugoslavia in the 1990s that exceeded 76%. The rate of inflation nearly doubled each day until it reached an unfathomable rate of 313 million% a month. A highly inflationary economy means if in the past 3 years the cumulative inflation is more than 100%. Some of the highly inflationary countries are Argentina, Lebanon, Sudan, Venezuela. If the functional currency in such an economy is Saudi Riyal, we will use the remeasurement method, which is a temporal method. Now let us go back to translation and remeasurement. If a foreign entity does not maintain its records in functional currency, the local currency accounts are measured into the functional currency using the temporal method. Remeasurement is the process of translating the accounts of a foreign entity into its functional currency when they are stated in another currency. Translation accounts measured in the functional currency are translated into the reporting currency using the current rate method. We have not talked about the current rate yet. Please note that translation is done using the current method and adjustments are recorded in the balance sheet. In case of remeasurement, use the temporal method and all the adjustments are recorded in the income statement. The current method is used in a normal business situation, that is, the subsidiary is operating in a foreign country and the local currency of that country is the functional currency. If the subsidiary in the foreign country do not use Saudi Riyals or is not a local currency but currency of a third country, then we follow two steps. First, remeasure the third country currency, that is the functional currency, using the temporal method. Second, translate the functional currency to Saudi Riyals using the current rate method. Next, let us talk about the translation method, also called the current method. Just keep in mind that the adjustment will be recorded in the balance sheet into OCI. When the company translates current assets and current liabilities, then the company applies the current exchange rate. When the company translates paid in capital, then it applies historical rate. When translating beginning retained earnings, it applies the ending balance of the prior year. When translating dividend, it applies historical rate when dividend is declared. When translating the revenues and expenses, it applies the average exchange rate because sales take place throughout the year. The cumulative translation adjustment is recorded in the balance sheet, and the current year translation adjustment is recorded under other comprehensive income in the balance sheet. If the remeasurement method uses temporal method, the adjustments are recorded in the income statement, and when translating monetary assets and liabilities such as cash, accounts receivable, accounts payable, investments, anything that qualify as a monetary asset and liability, then the company applies the current exchange rate. In case of assets and liabilities carried at historical cost, use the historical exchange rate. Assets and liabilities carried at current rate values, apply the current exchange rate. Revenues and expenses related to assets and liabilities translated at historical rate. For example, in case of a long-term asset, will have depreciation, which is an expense related to a historical asset, therefore apply the historical rate. In case of converting other revenues and expenses other than those related to the historical rate, is exchanged using the transaction date. This is done as the company may not be able to keep track of the transaction date, so the company applies average rate. So we have explained the current rate method and the temporal method. We have also explained the use of remeasurement and when we use the translation method. I repeat, when using translation method, use the current method. When using remeasurement method, use the temporal method. Finally, let us solve a question on identifying the functional currency. Indicators that the local currency is also the functional currency include all the following to accept. So there are 3 good answers and there is 1 wrong answer, and let us see. The majority of cash flow are in the local currency. So is this a determination of the functional currency? And obviously yes. So A is not the answer to be selected. Sales prices are determined by local market condition. Yes, sales is based on the local market. Number C, financing is generally from the parent company or guaranteed by the parent company, and the answer is no. So this is the answer in this question. Now when the company receives money from a subsidiary in a foreign company, then the company will exchange this currency, and it doesn't make a difference if it is the functional currency or not. So C is the correct answer in this question, but look at number D as well. Production cost and expenses are determined by the local condition, and answer is yes. This is one of the main factors that state whether it is a functional currency or not. So financing is definitely the weakest one of these 4, so answer is C in this case. In the sessions to follow, we will solve numericals related to current method, temporal method, remeasurement, and translation. So this completes the 5th part of our explanation of translation of foreign affiliate financial statements. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.